Hello, everyone. Thanks for tuning into our podcast. I'm with Ashish Akaria today. Ashish is a certified public accountant and real estate investor. He is also the founder of investor-friendly CPA firm, providing advisory, tax, and accounting services to real estate investors across the US. I am looking forward to the episode as Ashish has a deep understanding of complicated tax issues, tax planning, and tax-efficient short-term rental acquisitions. Ashish, good to have you on my podcast, and let's dive into it. So I would like to start with, what is the short-term rental tax loophole? If you can give us a breakdown on that, quick.
Sure. Hey, thank you for having me, Arda. So what we need to understand is what is short-term rental and why does it matter to investors who want to save taxes? Normally, especially like say engineers and doctors, they can make a lot of money to their practice or to their W-2s, right? And then they'll go invest in real estate and they'll have zero tax savings, meaning they cannot use real estate to offset their W-2 income or a business practice income. Normally, it doesn't work like that unless you qualify as something called real estate professional status, rep status. Most of the people with full-time W-2 will not qualify as one. That's where the short-term rental loophole kicks in. It's basically same kind of benefit, but it's on a specific kind of asset, which is a short-term rental. And from tax perspective, short-term rental is basically if your average stay of your tenants is less than 7 days. So basically Airbnbs and Vervos, those kind of vacation rentals. If you can buy those properties instead of long-term rentals or apartment or syndications you invest money in, on those kind of properties, if you buy them and if you can manage your involvement, you and your spouse's involvement correctly, then that short-term rental can offset your W-2 income. Okay, we have clients who have saved $400, even $500,000 in taxes because of this strategy. Again, it has to be extremely planned well, timing-wise, your involvement-wise, and your threshold-wise, cost segregation type of property, your improvements. So there's something called qualified improvement property. When are you going to do the renovations? Okay, those are very important for you to get the maximum benefit. If you plan all of them right, then the short-term rental, STR loophole, what it does is it takes the losses from your real estate and that will offset your W-2 income here. So that's the very basic understanding of short-term rental. Implementing it is complicated. You're going to have to work with your tax advisor, but understanding it and then actually getting invested in the deal is the first step. You need to understand why you're doing it. And don't jump into buying short-term rental. Just buying is not going to help you save taxes. Does that make sense?
Totally, yeah.
Now, I was going to say, so there are steps you got to follow. I don't know how detailed you want to get into this, but short-term rental loophole is basically taking the short-term rental and offsetting a W-2 income by meeting all the rules. That's the basic understanding of it.
Yeah. No. You summarize it perfectly, kind of fine. So who does this typically help?
Short-term rental? Who uses short-term rental loophole? It's mostly people who do not qualify as real estate professional. So there are two aspects to this, right? Why invest in short-term rental? You invest in short-term rental for better cash flow than long-term rental because normally they have a better cash flow. That's an investment decision, to get a better ROI on your investment. But if a tax comes into play, if for someone who is not a rep status, cannot really save money with their long-term rentals, then they will do a short-term rental. So I'll tell you who my client base who does short-term rentals are people who are, whose household do not qualify as reps. Doctors, the big ones, engineers, right, who have full-time jobs, business owners who cannot spend too much time on real estate will do this, especially 2024, 2025, 2026. They're trying to bring back 100% bonus depreciation, one of the best years you can do this. So those are the people who do this.
Okay. No, that's what actually I was trying to figure out. So let me, kind of give you a specific example and let me run this example by you because you are the, the CPA.
Sure.
So if you are in the highest tax bracket right now, which is 37% as of today, correct me if I'm wrong, you are paying 37 cents per dollar you are making. Let's say you have an additional $250,000 at the 37% rate.
Yeah.
On that $250K, you are paying $92,500 in tax.
Yeah.
That's a lot of money. That's substantial amount of money. That's a down payment on your next rental property. So I just wanted to, kind of run that, kind of scenario by you and see what your thoughts are.
Absolutely. The calculation, I can, if you really want, I can show you the calculation, the rough calculation of how this actually works in like 2 minutes. But if you ignore all of that, if you understand your marginal tax rate, how much can you offset your W2 income, and realize what is your threshold is. Because everyone has a threshold how much they can invest in real estate and save taxes. That depends on if you're W2 employees or you have your own practice if you're a doctor, because both of them have different threshold. Because W2, you have a certain amount you can offset. Show you this really, really quick, and this is going to really help you understand how much can you save, okay? Let me show you this number. This is going to be most valuable to your audiences and everything. Let me just walk you through this number, and you'll see how how they can actually understand and why they should be investing in real estate. I'm going to share my screen. It's going to take me a minute to show this. This is how it works. You can see my Excel, right?
Yeah, I can.
Again, don't worry about a lot of other details. This is not, I'm not doing any planning. This is our planning module we take our client through. Let's say you live in California and you're married, and nothing else matters. You're not you make as a doctor, you make $500,000. Your spouse, let's say, has her own small photography or any other kind of business, and she makes around, and let's say $80,000. Okay, then I just want to show you what can you expect, because remember, when you make that much amount of money, when you go file a tax return, your marginal tax rate is around 46%. Every dollar you're making, you're paying 46% in tax, right? At that level. So what can we do to offset most of your taxes with what we are talking about, especially short-term rental, is this very simple. And I want everyone to understand this. In 2024, which is this running year, you have until December to do this. If there's 100% bonus depreciation comes back, then this is how it works. What is our goal? Our goal is pretty simple. This is what's happening. Look at this. Your taxable income is going to be around $600,000 with the numbers I just ran. You're going to pay $200,000 in taxes. That's the tax you're going to owe to the government. Very rough number, federal and state. Okay, here. Our goal is to minimize this amount as much as we can so that most of this comes back to you. That's the goal. How to get there? With 100% bonus depreciation, with cost segregation, 23%, let's say, in a single family house. For someone like this taxpayer, your threshold is around 2.6 million. So if you were to go buy, let's say 2 or 3 properties that reaches that $2.6 million, your tax savings is $162,000. You're completely wiping out your federal taxable income. You're saving $154,000 at the federal level. And the state level, there's no bonus depreciation, so rough amount is around $8,000. Together, it's almost $163,000. So how powerful that number is? This is how powerful the number is. To save this $162,000, that's actually after-tax money. You actually get the entire thing. In your tax package, 46%, if you had to go earn this $162,000 from W2 or business, you would actually have to make $285,000 before tax. If your spouse gets involved and if you can save $162,000, that means she's basically going and earning $185,000 of W2 income. Okay, that's what the number is. Again, don't get too hung up on the numbers. The concept, it can be complicated. Okay, just buying the property is not enough. You're going to have LLC structure. We walk you through everything like that and trust and everything to make it happen. But the concept you need to understand is, how does this work? What is my threshold I need to buy? Because remember, buying less or more doesn't give you extra benefit. Those are the things I wanted to tell you. But again, I'm going to stop my share because it can get confusing and a lot of numbers. You're going to have to work with your tax advisor. But that's what you're saying earlier, right? If you have a W2 income, if you have small other incomes, what is the threshold? How much should you be investing? And how does it work? You have to work with a tax advisor and an advisor like Arda so they can walk you through the process.
This was an excellent, kind of example. I mean, definitely, kind of clarifies, it helps, kind of everyone to see, kind of what type of, kind of tax benefits, kind of we are talking about. But I just want to be clear about one thing, and it's important, to mention this. We never say, buy short-term rental properties for only tax benefits. The golden rules are invest for cash flow first, appreciation second, and tax benefits third. I just want to be clear on that, and I assume you would concur with, kind of my statement, right?
Absolutely. I mean, most of the clients, 2 types of client. If you are just starting in real estate, then always cash flow is the first thing. I don't even buy for appreciation. That you never know. Market, depending on your situation, you might have to sell the property early enough. If you're a little bit high net worth individual, cash flow is not an issue to you, then sometimes it's okay to buy for appreciation if you're going to save $100,000 to tax savings. Because remember, long-term rental, if one property saves you $100,000, it's going to take you almost 30 years for property to cash flow $100,000 But if you're getting that from the first year from tax savings, that is kind of your cash flow, right? So it really depends which bracket you're in, what is your investment journey, and what is your portfolio. Because sometimes even a long-term rental can save you taxes if you have the right kind of portfolio optimization. A lot of things goes into that. But what Arda says, I agree with that. Cash flow, appreciation, and tax savings. Sometimes tax savings and cash flow, you need to look at them together, because tax savings it increases your cash flow the first year and any other year.
I couldn't agree, more on that. Anyway, this was a great, episode. I really, appreciate your time and, educating us on, tax benefits of, short-term rentals. So for our audience, if you'd like to learn more about STR tax loophole and why, invest in short-term rentals, check out our website, strtaxloophole.com. Thank you, and see you all on the next episode.
Perfect. Thank you.